So we've added to the show an Ask the Consultant segment. And so joining us now is Duncan from Lincoln Financial Group. Sean, the floor is yours.
One of the first questions I'd like to ask you about is Cammack's success at the state level. What best practices are you putting into place and seeing with those plans, and how do you see that may trickle down to the municipalities, the special taxing districts, cities, that sort of thing?
You know, we've had success over the last several years in the state market and the municipal market. And I think why is because our team approach has really resonated. But we're really looking outside the box, and we're taking advantage of some of the newer techniques and tactics of the record keepers and administrators. Things like behavioral finance, really looking at wearables as an example, applications, computer applications, device applications, to really use those in order to reach participants. So I think what we're trying to do as newer entrants, and I've been in the consulting field for over 8 years. I've been working with government plan sponsors for a long period of time. Our firm has as well, but in different market segments in higher ed. But taking that deep dive approach to the market that we've done in other places and apply it to these state plans, and I think it's started to resonate. Clients, no matter if they're states, municipalities, corporations, want that hands-on customized approach, and we think that is meaningful. We want people to see value in what we bring, and as an intermediary, it's our job to kind of create a marketplace and to create a marketplace of ideas.
Let's get a little more specific about that, or look to the future perhaps. What things are you seeing on that jumbo scale, whether it be within the government sector or the corporate sector or the higher ed sector, that you feel like are getting traction and you feel like will ultimately drive down within the smaller plan sizes?
We've been very successful at the state and municipal level of focusing on concepts like financial literacy. That's a very important concept because people can be in a defined contribution plan but not understand the basic concepts about managing finance. That's something that can be applied and will be applied from the large end to the small end of any particular plan. I talked earlier about custom target date funds. I think that's one that will take time to produce. We see many vendors and investment managers try to come up with a custom target date approach that is scalable, but I think that's something that may be a bit of a challenge to implement long term, because at the smaller plan levels you just clearly don't have the asset pools in which to offer a product at a scalable and cost efficient manner. So I think those are really two examples. When you look at stable value, we've seen a pivot since 2008. We saw clients move away from general accounts to custom or separate accounts or collective trusts, to separate or bifurcate them from the insurance company. That took some time to kind of filter down. Now we see things changing again. Clients are very rate sensitive, and we've talked during the segments of the show about interest rates or crediting rates and the impact of that. We've talked about doing the proper due diligence, but at the end of the day, the participant, the employee, doesn't necessarily care about the protection afforded by a separate account. What they care about, because they're very myopic oftentimes, is what the crediting rate is. And I think that myopia, if you will, focuses the committee, and so I think we will see a shift back to general accounts because they typically have better crediting rates.
What is Cammack doing? What are you doing as a consultant in working with your clients to prepare them for a rising rate environment? And what are some of the key opportunities that you see that plan sponsors should be looking at and evaluating?
Well, certainly we've had a lot of market volatility the last few weeks and months. Greece, Puerto Rico, certainly the emerging markets, China, are a real concern. We're also facing significant pressure on the Federal Reserve to raise interest rates. And that is something that will impact plan sponsors of defined contribution plans and also defined benefit plans, by the way, in a multitude of asset classes, in particular stable value, but also fixed income. In the terms of stable value, it's not just me. I want to be very clear. It's not just me out there consulting. We have a team approach. It's Mike Sanders, Emily Wrightson, Denise Burns, who heads our investment team and research team. And we're out there giving thoughtful analysis around stable value and the portfolio construction. So as an example, there's a state out there that has a stable value fund. It's a custom stable value fund, and has chosen to maintain an allocation to an intermediary or that follows the Barclays aggregate index, but also allocate a portion of the investment portfolio to unconstrained bond to give the manager the tactical ability to go outside the mandate. That's a kind of a unique and refreshing approach because as we're looking for yield, so clients or portfolio managers are building in this rate increase going shorter duration, that's impacting yields and the crediting rate. And so how do you mitigate that, or how do you maintain a higher than a 1.5% net crediting rate? Well, you can go unconstrained. So you can start looking at different credit qualities, different durations in order to get you the necessary alpha to increase the crediting rate. Still, while still monitoring book to market, which is essential. You want to make sure that you're maintaining something close to 100%. You don't want to get into a situation where you're not. So that's a real area that we're focusing on. The other part is portfolio construction. So I mentioned separate accounts, but commingled or collectivized types of products where you're pulled with similar plans. It could be a 457, a 401A, a 401K. Typically, they're pulled together. That's a way to kind of bifurcate yourself from the potential for bankruptcy by an insurance company who's providing the guarantee.
Tell me a little bit about ways that you have, as a firm or as a consultant, worked with your clients in the government sector to bring in the good ideas, those ERISA best practices, if you will, to the government sector. How has that gained traction? What are some of the questions that you typically hear from your plan sponsors about that?
I think that's a great question because traditionally it's been kind of a siloed approach in consulting to say, okay, here's what one government does or this is what one corporation does. Cammack Retirement works in all these different market segments, and so I think one of the advantages that we have is we can leverage those experiences and say, okay, well, here's something that could apply from point A to point B. A perfect example of that is a communication strategy that we are rolling out. So you mentioned earlier interest in some things that we're doing different. We are taking a more strategic approach to communications and education, applying fee disclosure, which were the rules in 2012, from ERISA plans, which is important, to non-ERISA plans. Why not? The information's there, the infrastructure's there, the record keeper. A firm like Lincoln has the infrastructure in place to do fee disclosure, whether you're a ERISA plan or a non-ERISA plan. It's a matter of implementing it. So I think those are just some, but not all of the examples.
Let's talk a little bit about how you have seen the government plan space change, develop, and evolve, especially over the past 5 to 10 years.
Sure. I think, initially, like the 403 market, so Cammack traditionally for the last 50 years has been focused on the tax-exempt market, 403B. For those who aren't familiar, although I know there's a session today on 403B at NAGDA, 403B plans tend to have multiple vendors. They could have anywhere from 3 to 100 vendors, depending on the size of the plan. That traditionally in the 457 space, in the government space, that was the service model 20 years ago. There has been a migration, like what's going to occur over generations in the 403B market, a consolidation. So there has been great consolidation in the 457 market. You've seen slimming down from multiple vendors, 3 to 5, down to 1. It makes sense for a lot of reasons, most importantly cost. And cost, as we know from the fee disclosure rules in 2012, really impacts a participant's retirement readiness.
Tell me a little bit about how you are evaluating vendors within the RFP process. And we talked a little bit earlier about the fact that there is vendor consolidation going on. Is that a factor that you're considering? And if so, can you describe how you're addressing that?
Sure. I think you bring up some really good points, and I think as part of the educational process and due diligence process and evaluating proposals, you certainly have to consider the status, if you will, of an organization, especially in today's environment where there's a lot of consolidation. Traditionally, the evaluation of a vendor is in a multitude of areas: competency, capability, staff, product offerings, ability to offer other products on the platform. Can be a little nuanced if you're talking about a 403B plan versus a 457. But your comment about consolidation is important, and I think what you have to do is actually have a conversation about what the market should and could look like. One area that we get, I wouldn't say of concern, but one topic of conversation is often commitment to market. How important is that? And I think in the RFPs we write, we're looking for vendors. Well, first of all, if we're doing work in the government market, it's open. It's an open bid process typically. There's a procurement process, and anyone and their mother can respond if they want. And oftentimes they do. They have to meet the qualifications minimums.
Right.
But I think that, from our perspective at Cammack, we want the best provider. It doesn't necessarily mean we want the best government provider. We want the best provider. We want someone who is on their toes, not on their heels, who is innovative, agile, and has shown and demonstrated that they can deliver services to the market that we're servicing. So it could be a higher education organization or it could be a government market.